But from extreme defensive domestic, let's go across to the one which is on the offensive right now, the way down, the IT sector. You know, IT Rima is everything that FMCG isn't, apart from the fact that the only thing that is common is the underperformance that we're seeing for both of them.
Indeed. So let me just quickly run you through what brokerages are saying now. First, Bernstein says the impact on Indian IT over the near term will be uncertainty in terms of tech budgets and spending. So their expectation is tech budgets will get pushed out further, and that will drive lower growth. The worst case scenario is that a global financial crisis, way back in 2008 kind of a scenario, when the global world, slipped into a deep recession. And at that time, Indian companies had reported a 10% quarter-on-quarter revenue growth. TCS was down 6%, in terms of a revenue growth sequentially in Q4 of calendar year 2028. Accenture was down 13% in terms of a top-line growth. Now, Bernstein is saying that that's not the scenario that they're anticipating, a GFC kind of a scenario, but they do anticipate that growth rates will get impacted. So they prefer quality. Their bet lies with Infosys in the large cap space and high growth mid cap companies like Coforge and Persistent. They're underweight auto ER&D companies like LTTS and Tata Elxsi. Now, JPMorgan is saying that when can the stocks potentially bottom out? The bear case scenario for them is that there is no growth for large cap IT names like Infosys, TCS, HCLTech in FY26 and no margin expansion. If that is the case, then we're staring at deep EPS cuts for FY27. And if you apply the bottom PE multiple, then you're still looking at downsides of 7% for TCS, 6% for Infosys, and 14% for HCLTech. For mid-caps like Coforge and Persistent, etc., and some of the others, we can potentially, in a bear case scenario, right, that is no growth. In FY26, we could see EPS cuts of 10 to 15%, and then there could be downsides of 13% for Coforge and 25% for Persistent. So their recommendation is stay light on IT, don't buy into any stocks in the earnings season. A conservative guidance commentary from IT companies could drive stock prices lower, and that perhaps could throw up an opportunity. So they like Infosys and some of the growth mid-caps. Macquarie, on the other hand, believes that the current market reaction is overdone, and if you have a long-term time horizon, then this is an opportunity to load up on the stocks. Back to you.
Yeah, but you'll have to have nerves of steel and a stomach to, to withstand that whole volatility, digest that volatility, if you want to be that braveheart buying IT on days like these. Thank you very much, Rima, for bringing us the street view. Sector definitely under pressure.